Now let's move to the next part of the chapter, that is the fourth part, types of joint arrangements. This is a very important classification chapter because once classification is wrong, accounting will also go wrong. Overall structure of this part. The types of joint arrangement part is divided into two major areas. 1. Assessment of whether a joint arrangement is a joint operation or a joint venture. 2. Multiple joint arrangements under a single framework agreement. Now, within the first area, the assessment is further divided based on whether a separate vehicle exists or not. So, once we have already identified that there is a contractual arrangement and there is joint control, we now ask the next crucial question. Is the joint arrangement structured through a separate vehicle or not? Before classification, quick overview. Before going into the flow, let's first quickly understand what is a joint operation and what is a joint venture. Joint operation, basic idea. In a joint operation, parties have rights to assets. Parties have obligations for liabilities. Accounting is done by line recognition of assets, liabilities, income, and expenses. Think of it as direct ownership and direct responsibility. Joint venture, parties have rights only to net assets. Accounting is done using equity method. Here, parties do not directly own assets or owe liabilities. Core difference, very important. Joint operation, right to assets, obligation to liabilities. Joint venture, right only to net assets. What is a separate vehicle? A separate vehicle means a separately identifiable financial structure, such as a company, LLP, partnership, AOP, trust, statutory body. This separate vehicle is often called a special purpose vehicle, or SPV. Step 1. Not structured through a separate vehicle. Let's start with the simplest case. If a joint arrangement is not structured through a separate vehicle, it is automatically a joint operation. Why? Because the contract directly specifies rights to assets and obligations to liabilities, sharing of revenue and expenses. Important point to remember, even sharing or operating a single asset together is still a joint operation, as long as no separate vehicle exists. Step 2. Structured through a separate vehicle. Now comes the main and most tested part. If the joint arrangement is structured through a separate vehicle, we need to go through 3 layers of assessment. 1. Legal form of the separate vehicle. 2. Terms of the contractual arrangement. 3. Other facts and circumstances. Part 1. Legal form of the separate vehicle. First, we examine the legal form. We ask one simple question. Do the assets and liabilities belong to the separate vehicle itself? If legal form indicates separation, assets and liabilities belong to the separate vehicle. Parties have rights only to net assets. Conclusion, it is a joint venture. If legal form indicates no separation, assets and liabilities belong to the parties themselves, not to the separate vehicle. Conclusion, it is a joint operation. Very important exam point. If legal form itself indicates joint operation, we stop here. No need to check contract or other facts and circumstances. Part 2. Terms of the contractual arrangement. Now assume a separate vehicle exists and legal form indicates joint venture. We now check the contract. Key rule, contract can override legal form. When contract indicates joint operation, even if legal form suggests joint venture, it becomes a joint operation if the contract gives rights to assets and obligations to liabilities. This means parties share costs, expenses, and liabilities. Creditors can claim directly against the parties. Conclusion, joint operation. When contract indicates joint venture, indicators include parties have rights only to net assets. Assets and liabilities belong to the arrangement itself. Creditors have no recourse to parties. Conclusion, joint venture. Common traps, very important. Profit or revenue sharing ratio does not decide classification. Equal or unequal ratio does not matter. Focus only on right to assets and obligation to liabilities, or right to net assets. Another key point, if parties give guarantees, it does not automatically mean joint operation. Substance matters. Who actually bears liabilities? Part 3. Other facts and circumstances. We come to this step only if legal form indicates joint venture and contract also indicates joint venture. Even then, the arrangement can still become a joint operation if both conditions are satisfied. 1. Parties take substantially all the output. 2. That output is the primary source of cash flows to settle liabilities. If both are satisfied, it becomes a joint operation. Otherwise, it remains a joint venture. Now coming to the second area, multiple joint arrangements under a single framework agreement. Sometimes parties enter into one umbrella or framework agreement but carry out multiple activities. Important point, one agreement does not mean one classification. Each activity must be assessed separately. How to assess each activity? For each activity, ask, is it structured through a separate vehicle? Do parties have rights to assets and obligations to liabilities? If yes, joint operation. If no, joint venture. Apply the entire classification logic separately to each activity. That completes the fourth part of the chapter, types of joint arrangements. Next, we move to accounting for joint operations and then accounting for joint ventures.